Hello, this is John Calverley, Chief Economist of Tricio Investment Advisors. In this short podcast, I will discuss whether COVID-19 recession is more likely to end in deflation or higher inflation, and the implications for investments and portfolios. In terms of asset classes, it's very clear that inflation makes a great deal of difference. If we get deflation, falling prices, then conventional bonds and cash are a couple of the best asset classes. With inflation, then index bonds, index-linked bonds, property, and real assets like commodities are the best investments. For stocks, though, they can do well in either environment, provided inflation isn't particularly high. We saw in the 1970s, with very high inflation, that stocks didn't do well. Worth noting that deflation reduces the inflation tax on interest and capital gains. So in that sense, deflation is good for investors, at least those paying taxes. High inflation in the UK only would actually offer opportunities abroad. So having foreign assets would help if the UK suddenly had a big bout of inflation. And finally, just a note on gold. It can do well in both deflation and high inflation. Right now, though, we see the price relatively high due to the uncertainty from COVID. So in the near term, we're expecting further disinflation. Inflation's already fallen, and we think it will fall further. Companies can't raise prices, neither can unions or labor ask for higher wages. So those are tending to subside, and that's bringing inflation down broadly, along with the fall in oil prices, which has exacerbated that trend. But some people argue, well, supply is curtailed because of the restrictions in various industries because of COVID. And also we're seeing that the money supply is growing rapidly. So isn't that inflationary? Our argument is no. And the reason is that the savings rate is very high. People have high incomes. They also have plenty of deposits, but they're not spending them. But that goes for companies as well. So I don't think that, at least in the next year or so, the very high savings rates or the rapid rise in money growth will lead to higher inflation. And if you look at the numbers, so far inflation has just been coming down. This is the core inflation rate, and we can see it's come below 1% in the major countries. You can also see that inflation expectations haven't really moved down all that much. People are not expecting deflation yet. And I think that's probably right. They came down a bit, of course, but and they're below the 2% inflation target, but not much below. Now, Japan had a huge crisis in 1990, and following that, it went into deflation, which has never really managed to fully escape. Inflation itself has only come back very, very mildly in the last few years, despite some big action recently. But I think the situation then was very different to where the West stands now. In 1990, Japan had this huge bubble in stocks and real estate, which then went bust over about a 10 or 15-year period. There was also a huge amount of corporate debt, which was gradually worked down over a long period. That whole process was extremely deflationary. The West has some excess debt in some areas, corporate debt in the US, securities, maybe some problems there, but nothing like the Japanese experience. Second reason is that the Bank of Japan was quite slow to respond to that deflationary, disinflationary trend in the 1990s. Whereas I think the Western central banks are going to be very active over the next few years to avoid deflation and to push inflation back at least up to their target. You can see here, if you look at the orange red line, that Japan has never really managed to get its money supply growing very rapidly, despite quantitative easing over time. All that did was keep interest rates very low, but didn't really get money growth going. Whereas if you look at the US, there's been this massive rise in money growth just in the last year. And although, as I've said, I'm not expecting that to be spent in the short term, it's there, and it can still create inflation in the longer run. So the conclusion, we think that the thing to worry about, over time at least, is inflation, not the risk of deflation. So central banks will keep the stimulus going. We'll see interest rates low for a long time. Quantitative easing will continue. And we think inflation will then gradually pick back up again from the rates 1% or even below that we'll see over the next year or so. But when it goes higher, I think they'll be slow to react. They won't respond rapidly. They won't take precautionary tightening measures like they did in the 1980s, for example, or 1990s. This time they will let it ride for a bit. So our overall conclusion then is that we believe long-term portfolios should be aware of the deflation risk and monitor what's going on, and we certainly should be doing that, but expect higher inflation in the longer term. I'm not talking about 10% inflation like in the 70s, but certainly 3 or 4% inflation in a few years' time, I think is a very real possibility. That's all from me. Look out for other podcasts and publications from my colleagues, James Chu, Head of Investment Solutions, and Jerry Salaya, Chief Strategist, and our range of publications. Thank you very much.